Joining me next on the program is Dave Morgan from the Morgan Report. And, Dave, I guess one of the themes in the precious metals market this week is from that song, I was talking to John Duty, and there's that song, Mama Told Me There Would Be Days Like This. And let's talk about the takedown in gold and silver on Wednesday of this week as Bernanke was on Capitol Hill. What's your view, and what was behind it in your opinion?
Well, a couple things. We've been through this before, but it continues to happen periodically. And just for review purposes, any market is moved by buying pressure or selling pressure. So in order to move a market, any market, the gold and silver markets are fairly large relative to, say, a penny stock or something. But it's massive amounts of selling at very strong periods of time. In other words, a lot of contracts in one trade, that type of thing. That's what it takes. And that's what took place. And so then it begs the question, well, is this deliberate or not? And I suggest highly that it is, because anybody that's professional or would have the ability to muster that many contracts in order to move the price has probably got a motive. And the motive is a lot of sales is going to move the price down. And then, of course, this question that usually comes up after that is, the motivation. And there's all kinds of motivations. But let's just look at the one that's the most obvious, and that would be profit. Well, how do you profit from that? Well, obviously in commodities and stocks, you can go short or long. One is the short sales. So the shorts selling more will obviously drive the price down if they sell a lot, and who knows where it's going to end up. But there's only one way. Another way to do it that is kind of like double dipping is that you load up on the options that are extremely cheap, especially going into options exploration, and you buy these way out of the money options that the day before so are basically worthless. I mean, any options trader that will look at that would say, you're buying those things for only 10 cents, but I mean, the odds of that coming in are so remote. Well, not if you got a lot of money, not if you're a paper bug, not if you know you're going to bomb it the next day. So this is something that, really infuriated me and others on this journey looking at this bull market in precious metals, is that the authorities that certainly have the wherewithal to understand everything that we just discussed, to just look the other way time after time after time. To say it's annoying is to put it in polite terms. But back to the question, Jim, there was a large sale in gold. Once it hit about the 1708 mark, I'm quoting this from an article that was written by Gold Alert staff that came out yesterday at 11:39 a.m. Basically what it says in this article is that someone on the gold side offed about 10,000 contracts traded. Well, that's a lot of gold on paper, and it dropped the price to about $40. And as we know, the selling continued throughout the day. Now, I got a lot of numbers off the internet, and I usually double check everything that I can. Sometimes I travel and I couldn't, but today I checked with my futures broker. I said, well, how much damage was done in gold as far as how many contracts? Now, I'm not talking a GLD. I'm not talking options. I'm not talking a lot of other numbers that can be factored in, and I can't look in these guys' heads. I mean, when they say that there was this much sold, I don't know what they're referring to because they're not really specific enough. But my broker told me on the near contract in gold, round numbers, about 300,000 contracts. That's a lot of sales. That's a lot of gold on paper. But my expertise, as everyone that listens to the show more than 2 or 3 times knows, silver. And silver, there's a few articles out there by some of the better-known personalities in the business, and their number was 45,000 contracts, which is roughly 225 million ounces. For my broker in the near month, which is the May contract, it was actually greater than that, actually fairly significantly greater than that.
Hey, David, let me stop you because this really looks like this was orchestrated. When you're talking about 200 and something million ounces of silver equivalent was sold in paper silver?
Yeah, 45,000 contracts with 5,000 per contract. So you're looking at whatever that is. I think it's 225 million ounces.
There's not enough silver around to deliver into that.
No, the inventory that the dealers actually own as a combined entity, all dealers, is 35 million ounces.
So 35 and they sold 200 something million. That's absolutely amazing.
Yeah, this is why, I'm beyond irritated. I mean, I'm trying to, again, choose my words to be polite, but frustrating is another good word. So here we have, over 225 ounces paper silver sold, drives the price down intraday like $4, open to close on the New York market, on the CME market, about $2.50. But what I want to point out, Jim, is something that new people in the market, even old people in the market, meaning people that are long-term bulls, been holding for a long time, and people new coming in the market for the first time. And it's a very big concern, and that is, these guys have all this paper money. They're banks, basically, and they can print up whatever they want. They can bomb these markets whenever they want. And I don't really want to play that game because they can't lose. And what I want to emphasize is that they will lose. The reason they will lose is that paper doesn't equal silver and paper doesn't equal gold. And I want to do an extremely small but very direct thought process for everybody listening. It took 45,000 contracts or 225 million ounces of paper silver to drive it down 250 open to close on the CME. And if we just go back a few months ago, Sprott Asset Management for the PSLV, the Physical Silver Trust, had a shelf filing for $1.5 billion. On an overnight offering, they rounded up about $300 million, and they bought roughly 10 million ounces of physical silver at 30. By the time that thing was closed and the physical silver was delivered, the price went up, I could argue quite easily $3, but I'll be conservative and say $2. So now let's think about this for a minute. The real silver market, the physical silver market, 10 million ounces of physical moved at $2, but it took 22 times that amount to move it down roughly the same amount. So you tell me who's winning. Jim, I'll go anywhere. I'll testify as an expert witness. I'll tell anywhere. I would say we're winning. I would say the physical market takes roughly 22 times less power, because it's the real deal, to move the market than the paper bombers take. So I know that they know that they can't keep this thing forever. So end of statement. I know I'm a little wound up, but this is something I want to really be emphatic about, because I'm tired of explaining that they are always going to win. Now, they're losing big time.
Well, Dave, I just remember when you first introduced me to silver. I'm glad I met you in 2001. It was at $4.